announcement. The profits have jumped 18%, have beat street estimates. We caught up with Arul Selvan, President and CFO. Let's hear him out.
Let me first start off with the provisions number, because generally on a sequential basis in Q4, we see a little bit of a tapering down with regard to provisions. And that's also a little bit to do with seasonality. Not seeing it this time around. Can you just take us through what's happened there?
Yeah, you are right. But what we have done this time is we have provided a little bit more on the consumer and small enterprises loans, primarily because, especially in the fintech segment, where we have been slowing down, as we have discussed earlier, and we are now more or less almost exiting most of the players. So when you are slowing down and exiting, you will tend to have slightly larger requirements on provisions. So to that extent, we are fortifying our provisioning requirements out there. So that had made the provisions seem to be a little higher. In rest of the products, it had followed the similar pattern.
Okay. Sir, is this done because there is a concern there or only out of prudence?
It's more of prudence, because when you're running down a book, you tend to have more of the bad apples, at the bottom of the barrel. So you better provide more so that you are fortified against any unexpected surprises out there. The other aspect also is in the rundown or the reduction in the stage 2, stage 3s in other products have also not been significantly larger as it used to be in Q4 in any typical year. So to that extent also the provisions reversals have been a little muted. I was just thinking on that, yes.
Yeah, okay, point taken. And sir, do you believe that there's going to be some amount of a spillover FY26 as well with regard to this book, or do you believe that there's enough cushion now?
There's enough cushion is what we believe, because we have provided in more than 150 days at around 75% and 180 days at 100%. So to that extent, recoveries are, we have seen them happen, and so that is why we have taken this call. So we should not have any more surprises or shocks in this portfolio as we move into FY26. Subject to the global and economic issues out there. You are seeing every other day, you are seeing each state coming out with their own thing of not wanting to pursue collections, like Karnataka, you're saying in Tamil Nadu. So hopefully that shouldn't deter payments. Yeah.
Point taken. So what's the impact like if Tamil Nadu were to impose this?
We need to see, because this is primarily focused on the MFI type of a borrower profile, so we should not have any large impact. But then sometimes there are some spillouts on other portfolios, but it will take a longer time. Not that we are being harsh in our collection efforts or collection mechanisms, so we should be not impacted that much. But I'm just saying that there will be fallouts if it depends on how it is imposed by the government, as well as how the others are reacting to this. We need to see.
Point fully taken. So while we are on asset quality, I also want to cover this base. Certain analysts suggesting that in the CV segment, there's been some headwind with regard to the way in which collections are happening. Are you seeing that headwind? They've done their channel checks, but I want, of course, you to give us, probably throw some light on this.
See, in the vehicle finance, in the CV segment, yes, there are a little bit of higher stage 3 impact, etc. So we are seeing some headwinds. Yes, it is true, but I think it is much lesser as compared to previous year Q1. But we need to wait and watch and see how it pans out. Thankfully, this year there are no elections, etc. So that should not be too much of setbacks as it happened last year. So we should have smoother Q1 and Q2 as compared to last year's Q1, where we saw sharp upswing in the vehicle finance stage 3 book.
If I were to just round this entire piece up, so your credit cost number has inched up from 1% and couple of years of very good credit cost, right, to 1.4%. What is it that you are looking for in FY26 and what's the aspiration like? Where would you like to be in terms of credit cost?
The credit cost, the company as a whole should settle in the range of around 1.2% over cycle. So primarily because it is also factoring in that some of the newer products will have a higher credit cost as compared to traditional products. So to that extent, you will have a higher credit cost, but that is adequately compensated by yield improvements in these segments. So thereby there will be the ROTA commitments would still be valid, and we will still be comfortable to reach the 3.5% pre-tax ROTA. So 1.2% would be the target, and maybe FY26 we need to see how it pans out. It should be in the range of 1.2 to 1.3% NCL overall company.
Excellent. And so what about growth? You're currently at nearly 2 lakh crore in terms of your AUM. So size-wise, you've grown very, very well this year. How do you see growth maybe in FY26 immediate term? And then thereafter, what's the aspiration like maybe in the next 2 to 3 years?
Yeah, we don't know the growth for the next 3 months. You are asking 3 years.
No, but sir, there would be an aspiration.
I'm just joking.
Sure, sir.
No,
but sir, there would be an aspiration. It could be 15%. Just trying to get perspective.
No, we have clear plans drawn, but I'm just joking considering the economic turmoil out there. Our target is to still work on a 20 to 25% AUM growth, which we will reach, certainly. That something is not removed from our focus, and that is what we will do. And we will endeavor to keep this 25% growth on AUM continuing in the years to come. That's the whole purpose of adding new products and new geographies, and that would help us sustain, even though there are certain specific product-related setbacks.
And so, it's an environment where rate cuts are going to be prevalent, if I can call it. We've already seen a 50 basis point cut. What's the impact of the existing cut on your margin? And what's going to be if, say, for example, there's going to be another 50 bips? Is the impact going to be equivalent, or are you going to pass through a large chunk of that? Just getting perspective on how you're looking at this.
See, if you look at it, almost around 20% of our book is linked to the benchmarks like repo or treasury bill, where we have seen the impact coming on the borrowing side. I'm talking. A large part of it is linked to bank MCLR, which unfortunately has not shown a reduction. Progressively, we need to see as a more rate cut comes, whether banks will reduce their MCLR, in which case we will certainly see a larger impact on our cost of funds. But the marginal borrowings will certainly come at lower price, and we will benefit out of that. We may have to share this on our floating rate book, which is the LAP and the HL, where we will have to pass this to some extent in relationship to their borrowing profile, that is a tenor profile. But we will stand to benefit on the vehicle finance book and the fixed rate books, because there is no commitment to pass on the rates, and so there we will benefit. This is the reverse of what happened a year or so back when rates came down and we were suffering, where rates went up and we were suffering with our lower yield vehicle finance book. So this time we will see the reverse happening. So there should be clearly NIM improvements in vehicle finance as we move forward.
Okay, and therefore, sir, how should all of these moving parts impact ROA? Your currently PBT ROA is 3.3%, which is largely what you've guided for pretty much for a better part of this year. Next year, believe that there is upside bias to this guidance. Would you say so?
Yes, there should be 10 to 15 basis points, and if we are really lucky, we should reach the 3.5 ROTA target, which we are always endeavoring to achieve.
So that's the management of Cholamandalam. But moving on, we also caught up with Umesh Revankar, Executive Vice Chairman at Shriram Finance. The stock is seeing cuts of nearly 8%. Let's quickly hear him out as to what the outlook he has.